Welcome to Debt Matters.
It's good to be here.
Usually when we start talking about parliamentary bills or legislative updates, there's a tendency for eyes to glaze over.
Yeah, it can feel a bit distant, can it? Like just administrative noise.
Exactly. But today, we're looking at something that really redraws the map for credit risk here in the UK. And I'm not talking about some minor tweak. This is a government decision that has, well, immediate and very practical consequences for anyone out there trying to get an invoice paid.
It's a change in the baseline risk environment. Policy decisions made in Westminster, they trickle down very quickly to the credit controller's desk.
So let's get right to it. The headline news we're unpacking is that the UK government has, for all intents and purposes, shelved the long-awaited audit reform bill.
That's right. It's been paused indefinitely, which in politics often means it's gone for good.
Now, before we get into the nuts and bolts of what that means for day-to-day operations, I just want to set the stage a little. We are not here to complain about politics.
No, absolutely not.
And we're not here to debate whether this was a good or a bad move ideologically.
No, that's not our job. Our function is to break down what this U-turn actually means for the risk environment out there. Because if the rules at the top aren't changing, the risk on the ground certainly is.
And that leads us right to the core of this whole discussion. If the regulatory guardrails, the things that were supposed to give businesses a bit more protection, if they're not getting any tighter, then the burden just shifts.
It does. It shifts squarely onto the internal credit controls of every single business.
So the system won't save you.
The system won't save you, so you have to save yourself. That's the reality. And what we're going to do is walk through a sort of operational playbook to help you do exactly that.
Sounds good. But first, let's just make sure we all understand the mechanics of what actually happened.
Okay.
Let's lay out the facts. What was the announcement? How did this news come out?
Well, it wasn't some big press conference or anything like that. The Department for Business and Trade decided not to consult on the planned legislation. And this was all confirmed in a letter to the Business and Trade Committee.
So quite low-key. And this wasn't some new idea they were just scrapping, was it? This has been in the works for a very long time.
8 years. This effectively pauses, or maybe ends, an 8-year push for a whole package of reforms.
And you have to remember the context here, right? This all started building after the Carillion collapse back in 2018.
Yes, exactly. That was the real catalyst.
And that sent huge shockwaves through the construction sector and, frankly, the wider economy.
It really did. And the original goal of all these reforms was to set up a new, more powerful regulator. It was going to be called the Audit, Reporting, and Governance Authority, or ARGA.
ARGA.
And the ambition behind it was much tougher oversight, better director accountability, basically trying to stop these huge corporate failures from just happening out of the blue.
So after all that, why the U-turn now? What was the government's official rationale?
Well, in that letter, the ministers laid out 3 specific reasons. And again, we're just reporting what they said here. The first one was growth first.
Growth first. Okay, that sounds like a fairly standard political slogan. What's the thinking behind it?
The argument is that they want to prioritize deregulation, to reduce the cost burden on businesses. The idea being that adding new layers of audit requirements, new reporting rules, it creates a drag on the economy that might stifle growth.
I can see the surface logic there, but surely there's a counter-argument. Does less regulation always lead to sustainable growth?
Well, that's the tension, isn't it? You've got accounting bodies, groups like the Institute of Directors, all pointing out that while deregulation might lower some immediate costs, it can also lower confidence.
Confidence from who? Investors.
Investors, suppliers, lenders. Anyone who relies on a company's financial statements. They all like to know that the numbers they're looking at are, real. If you start removing the checks and balances, you might get a short-term bump, but you could be building it on a foundation of volatility.
Because nobody likes surprises, especially not investors.
Nobody. Which brings us neatly to the second reason they gave, this idea of improved standards.
What do they mean by that?
The ministers argued that audit quality has just naturally improved since 2018. The suggestion is that the industry itself, having been burned so badly by Carillion and other failures, has basically tightened its own ship.
So the argument is the market has corrected itself, and we don't need the new law anymore.
That's the claim. It's a bold one.
Is there any truth to it?
I mean, firms are certainly more cautious now, there's no doubt about that. But without the statutory backing of a powerful regulator like ARGA was meant to be, it's very hard to say the underlying structural issues have actually been solved.
It feels a bit like saying we don't need speed limits Because most drivers have become a bit more responsible lately.
That's a very good analogy, yes.
Right. And what was the third reason?
The third one was just about practicality, parliamentary logistics.
So time, essentially.
Basically, yeah.
Yeah.
Limited time on the parliamentary schedule and a reluctance to spend government time and resources consulting on policies that are, in their view, unlikely to progress anytime soon.
Okay. So time, money, and a belief that things are already better. But I want to pivot now to the practical side of this. Let's really connect the dots. Why should a credit manager, CFO, or a collector listening to this actually care that the audit reform bill has been shelved?
This is the crucial part. This is not just some accounting drama for people in the Big Four. It changes the risk environment for anybody extending trade credit.
Okay, so in what way? Let's break that down.
Let's think about what the reform was meant to bring in. One of the key components was something called the resilience statement.
A resilience statement? What on earth was that supposed to be?
It would have required company directors to explicitly state in writing how they were managing risks to the business. Not just today, but over the short, medium, and long term. It was a forward-looking document.
And without it?
Without it, we lose a really important potential early warning system.
So instead of getting a bit of a forecast, we're stuck just looking in that rearview mirror again.
Precisely. We are right back to relying on annual accounts, which, as we've said, are purely historical. If the oversight regime is weaker, or at least if it doesn't evolve as planned, it just means companies can hide distress for much longer.
So the risk for you, the creditor, is that you only find out a counterparty is in serious trouble when you're already standing in the queue with every other supplier they owe money to.
And by then, it's too late. You wanted that heads up 6 months prior, when the rigorous reporting might have flagged a problem.
You want to know when the ship is starting to take on water, not when it's already halfway to the bottom.
You've hit the nail on the head.
And this brings up a concept you've talked about before, which is this idea of disorderly failure.
Yes, and we need to be very clear on what this means. When governance weaknesses aren't flagged and aren't addressed early on, businesses tend not to fail gradually. They don't wind down gracefully.
They fall off a cliff.
It's exactly like a cliff edge. If you have strict audit controls and reporting, a company might be forced by its auditors or its bank to restructure or to address solvency issues while they still have some assets and some options.
But without that external pressure.
Without that pressure, they just keep going until the cash literally runs out one Tuesday afternoon.
Okay, and for the creditor on the other end of that, what's the tangible difference between a messy, disorderly insolvency and a more managed one?
Oh, it's night and day. It's the difference between getting something back and getting nothing.
How so?
In a messy insolvency, the first thing you find is that the records are often completely chaotic. This leads to way more disputed balances because, frankly, nobody on the other side even knows what was delivered or what was agreed.
So your invoices get challenged?
Constantly. Then you find there's less asset coverage because they've been selling off anything they can to keep the lights on for months. And ultimately, all of that means much, much slower distributions from the administrator, if you get anything at all.
So the lack of this reform means that the business failures that do happen are probably going to be more sudden and more expensive for their creditors.
That is the very likely outcome. It fosters what you could call a can-kicking phenomenon.
Just putting off the inevitable.
Yes. Failing companies try to obscure the reality of their finances. And if the audit regime isn't forcing them to declare certain risks or liabilities clearly and early, they will just kick that can down the road, always hoping for some miracle contract to save them.
There was also a piece in the original bill about director accountability, wasn't there? That seems like a big piece to lose from the puzzle.
It is a huge piece. The reforms were designed to put much more direct responsibility onto individual directors for the accuracy of their company's reporting and, crucially, their payment practices.
And with that bigger package, as they called it, now paused, we lose that deterrent.
We do.
But does that really change behavior? I mean, do directors honestly sit around the boardroom table worrying about a regulator like ARGA?
They worry about liability. They worry about being disqualified or being held personally responsible. Without that regulatory stick, there is a real risk of directors feeling more comfortable stretching their creditor days to manage their cash flow.
Using their suppliers as an informal credit line.
As a bank, an interest-free bank.
We see it all the time. The terms say 30 days, but the culture is to pay in 60 or 75.
And in this kind of environment, it's the trade suppliers who end up acting as the financial buffer for these stressed companies. You become the one providing the interest-free loan that keeps them alive while they hide the real problems from everyone else.
That's a pretty sobering picture. The safety net that we all thought was coming simply isn't.
No, it isn't.
So let's get to the solution. This is the most important part. If the system won't save us, what do we do? Where do we go from here?
We have to shift our mindset. It's a fundamental shift. The central theme from here on has to be, the system won't save you, so you must tighten your own playbook.
You can't rely on external regulators to flag risk for you anymore.
You have to become your own regulator. You have to do it yourself, internally.
Okay, so we've broken this down into 7 practical actions people can take. Let's start with the first part, which is all about detection. Action number 1 is upgrade early warning triggers.
Yes. And as we've said, this requires moving away from just looking at the annual accounts once a year.
We've established those are historical, they're backward-looking. What are we replacing them with? What's the alternative?
The alternative is operational triggers. You need to be looking at the data your own business generates every single day.
Okay, give us some real-world examples. What should a credit controller be looking out for on a Tuesday morning?
Broken promises are the most obvious one, of course, the checks in the post. But you have to look closer. Look at the detail of partial payments.
You mean when they don't pay the full invoice amount?
Yes, but specifically look for round sums.
Round sums.
Round sums are a classic sign of cash flow distress. If the invoice is for, say, £12,450 and they send you exactly £10,000.
They're not just making a mistake.
No. They are rationing their cash. They're paying what they can afford that morning, not what they actually owe you. It's a huge red flag.
Okay, what about other behavior changes?
Sudden disputes. Invoices that used to sail through without a problem are suddenly being queried for tiny, trivial reasons. It's a tactic. It's a way to delay payment without having to admit they don't have the money.
A delaying tactic.
Yes. Also, look at changes in ordering patterns. This can go 2 ways. Either they start ordering way less than usual, which is an obvious sign of trouble, or they suddenly start ordering way more.
Why would they order more if they're in trouble?
To stock up on essential goods before they go bust and the credit lines are cut off completely.
And what about people? Staff turnover.
This is so often overlooked. If their finance director suddenly leaves, or even your usual friendly accounts payable contact quits without a new job to go to, you have to ask yourself why.
People leave sinking ships.
They do. These are the real-time signals. They tell you far more and far earlier than a balance sheet from 9 months ago ever could.
Okay, that makes perfect sense. So that's detection. Let's move to action number 2. Shorten escalation timelines.
Right. We all need to challenge that standard friendly chasing period.
You mean where people are very polite for the first, 45, 60 days? You don't want to upset a good customer.
It is a relationship business, I get that. But in this new environment, you just don't have the luxury of time for a slow dance, especially not in high-risk sectors.
Like construction or retail or hospitality at the moment.
All of them. In those sectors, you need a much tighter path to escalation.
So what does that look like in practice? What's the alternative?
It means earlier, more direct contact. Don't just rely on an automated email that gets ignored. Pick up the phone on day 35, not day 60.
And there have to be consequences.
There have to be consequences.
Yeah.
It means earlier credit hold thresholds. If a customer misses a key deadline, the supply has to stop. It might sound harsh, but you have to remember, you are in a race. You're competing with every other creditor for a limited pot of cash. You need to be the squeaky wheel that they have to pay to keep their own business running.
Okay. Action number 3 involves looking at your existing customers. Recheck the top 20.
This is what I call the mini refresh tactic. It's so easy to get complacent with your biggest customers, isn't it? Because they're your biggest customers. They generate all the revenue.
And we just assume they're too big to fail.
We all do. But Carillion was big. Wilco was big. This isn't about complacency. It's about prudence. So pick your top 20 accounts by total exposure.
And what are you looking for?
Don't just glance at the credit limit and assume it's fine. Dig into their payment behavior over the last 90 days. Has it slipped? Even by 2 or 3 days? Is there a trend? Are you seeing a small but steady increase in disputes?
And you mentioned checking the rationale behind the limit itself.
Yes. Ask the question. Why did we give them that £500,000 limit 3 years ago? What was the reason then? And does that reason still hold up today? If it doesn't, you need to reduce it.
It's better to have that slightly awkward conversation now.
Than trying to claw back £500,000 from an administrator later. It's a much, much harder conversation then.
Okay, so that covers detection. You're watching for triggers, you're moving faster, and you're double-checking your biggest risks. Now let's move on to the second part. Protection and leverage. Action number 4 is strengthen documentation.
The mantra here is really simple. When companies wobble, paperwork wins.
It's the unglamorous part of credit control, isn't it? The admin.
It is, but it's the part that saves you when things go wrong. When a company goes into administration, the administrator, their job is to look for reasons not to pay you. If there's a loophole, they will find it.
And if you have to go to court, the judge needs a clear paper trail.
They need proof. So what are we looking for specifically? We're looking for pristine records. That means signed contracts.
Not just an email chain confirming an order.
Absolutely not. A properly executed contract. It means having delivery records, proof of delivery, or PODs that are clearly signed, dated, and legible.
And clear dispute trails as well.
Yes. If a customer disputed an invoice 6 months ago and your team resolved it, make sure that entire conversation is documented and saved. The goal is that before litigation ever becomes necessary, your file on that customer is completely bulletproof.
You can't be scrambling to find this stuff after the insolvency announcement hits the news.
By then, it's far too late.
Okay, action number 5, segment for distress collection.
This is a really important one. It's about treating debt from a distressed company completely differently to a standard late payment.
What's the core distinction?
Well, a standard late payment might just be a simple administrative error, or maybe someone in their accounts team is on holiday. A payment from a distressed company is a sign that the business is fighting for its very survival. You cannot treat those two situations the same way.
So how do you handle the distressed ones differently? What's the process?
You implement a faster cadence of communication. You're on the phone with them every day, not sending an email every week. And you have to insist on a single point of contact who is a decision maker.
So you stop talking to the accounts payable clerk.
You have to.
Yeah.
The clerk is just following instructions. They can't sign the check. You need to be speaking to the finance director or the financial controller, and your team needs a script.
What kind of script are we talking about?
Pre-insolvency negotiation scripts.
Yeah.
You need to know what you're going to say when they give you the number one excuse, which is always, we're just waiting on a big payment from our main customer.
Don't just accept that at face value.
Never. Ask for proof. Ask which customer. Ask for a partial payment right now based on the cash they do have. Have your counter move ready for every excuse they throw at you.
Action 6 gets a bit more technical. It's about security. Review ROT and guarantees.
Right. And we need to get this right. ROT stands for retention of title. It's that clause in your terms and conditions that says these goods still belong to us until you've paid for them in full.
Most suppliers have this in their T&Cs. It feels like standard boilerplate.
It is. But just having the clause in your document is not enough. The failure rate of ROT claims in actual insolvencies is staggering. It's incredibly high.
And why is that? Why do they fail so often?
It usually comes down to something called the battle of the forms.
The battle of the forms.
It goes like this. You send your quote with your T&Cs on the back. The customer sends you back a purchase order with their T&Cs on the back.
No.
You're happy you've got the order, so you ship the goods.
And by shipping the goods, you've legally accepted their counteroffer.
Which means your T&Cs and your precious retention of title clause are in the bin. You are now trading on their terms, which almost certainly do not give you title over the goods you just shipped.
So when we say review security, what we really mean is review the whole contract formation process to make sure your terms are the ones that actually apply.
That is exactly it. And while you're at it, check your personal guarantees.
And what's that?
2 things. First, is it drafted correctly and legally enforceable? But second, and just as important, does the director who signed it actually have any personal assets? A guarantee from a director who rents their home and leases their car is worth nothing more than the paper it's written on.
A very good point. Okay, finally, action number 7, the go-no-go framework.
This is all about tackling decision fatigue. When you are in a high-pressure negotiation with a customer who is sliding into insolvency, you don't want your team making up policy on the fly.
So you define what a successful outcome looks like beforehand.
You define success before you even pick up the phone. Are you, as a business, willing to accept a staged settlement, a payment plan? If so, over how many months? What is the absolute maximum term you'll accept?
And what if they say no to your terms? What's the next step?
Then you need to know the trigger for legal action. You establish preset acceptances for your team. If they offer X, we take it. If they offer Y, we have to demand a consent judgment or a Tomlin order as part of the deal.
Can you just explain what a Tomlin order is?
Of course. It's a type of court order that basically pauses legal proceedings on terms that both parties have agreed to. The key benefit is, if they then default on that agreed payment plan, you don't have to start the whole court case from scratch. You can go straight to getting a judgment. It gives you real leverage.
So your team can make these decisions quickly without having to escalate every little thing.
Speed is your friend in these situations. The longer you dither and debate internally, the less likely you are to ever get paid.
Okay, so let's try and put this all together. The shelving of the audit reform bill. It's not just a political footnote in a newspaper. It is a signal.
It's a clear signal that the external environment for creditors is not going to get any safer. You should assume fewer external guardrails are in place. You should assume that distress signals from your customers will now come later than they used to.
Which means the winning move has to be an internal one.
It has to be. It comes down to faster detection and tighter proof. Success in this environment relies on your processes being sharper and faster than the creditor next to you in the queue.
I want to leave our listeners with one final thought to mull over based on what we've discussed about the messy insolvency.
Okay.
Ask yourself this question, honestly. If your single largest customer failed tomorrow morning, not next month, not next week, but tomorrow, would your current documentation, your contracts, your PODs stand up to the intense scrutiny of a sudden chaotic insolvency?
And if the answer is, I think so, or I'm not sure, you need to go and check. You need to make that answer a definite I know so.
Because in a world without these tighter audit reforms, that paperwork might just be the only safety net you have left.
Indeed. It's your last line of defense.
That's it for this edition of Debt Matters. Keep those ledgers clean, and we'll catch you next time.